Hello and welcome to LAT's Weekly Market Insights. The Reserve Bank of Australia were in action this week and kept the cash rate unchanged at a record low of spot 1% for the 16th month in a row, while noting that Australia's inflation has increased and further acceleration was expected. Now, these very predictable but yet still hawkish comments prompted a sharp move in the Aussie dollar. We can see here from this 30-minute chart the point of these comments being made an aggressive move higher. That move higher breaking through some multi-year highs, the high here set back from October of 2021. Now this rally was fairly short-lived and immediately the next day turned around and moved back lower as risk-off flows started to emerge within the market. We also saw a drop lower across much of the commodities sector, which also prompted and supported this continuation to the downside for the Aussie dollar. Now this weekly level at the moment, we can see that spike high prompted by the RBA's release, and now looking fairly well set here now for a weekly close of a big shooting star. Potentially an ominous sign here for the Aussie dollar over the weeks to come. Now that being said, policymakers were aware that growth and labour costs had been below rate, but are likely to be consistent with the inflation being sustainably at target. The committee mentioned that it will assess important additional evidence over coming months and other information and drop the patient pledge. Similar story to many of those other central banks, as it sets a policy to support full employment and inflation consistent with its targets. When we come across to the US, it was the ISM Services PMIs, which increased to 58.3, which grabbed most of the headlines. That's up from 56.5 in February. This is largely due to the easing in pandemic restrictions. But despite these positive figures, rising costs, logistical challenges, and supply strains still persist. Compound this with the ongoing geopolitical concerns, particularly the Russia-Ukraine war, which has impacted material costs, most notably fuel and chemical prices, has certainly created a lot of volatility and uncertainty for many businesses. Meanwhile, the Fed were back in action with the minutes from March. Many Fed officials would have preferred a 50 basis point increase in the Fed funds rate instead of the 25 basis point hike. The big talking point was actually the balance sheet reduction. Officials agreed that monthly caps of around $60 billion for Treasury securities and $35 billion for mortgage-backed securities would likely be appropriate. There is wide-scale speculation of if this is actually achievable or not, with the amounts phased in over a period of 3 months or modestly longer. That is higher than the $50 billion a month trim the Fed made back in 2017 and 2019. Now, despite all of that, the effect on the chart is little unchanged. We can see here down at the lows of the week at 7 o'clock when those FOMC minutes came out. A bit of whipsaw here. We saw an aggressive move lower back to the highs, and then we traded largely flat through the remainder of Wednesday and through Thursday's trading. We saw a slight risk on flow towards the tail end of Thursday into the tail end of the US session, and now we're just sat in a holding pattern back at significant resistance levels and just holding firm here on Friday during the European session. So a largely unchanged week here for the S&P. No major headlines or fundamentals in play here to give indice markets any clear direction for the time being. A lot of focus this week has moved to the voting in the first round of the French presidential election, which is due to start on Sunday. Emmanuel Macron leads over the other candidates, namely Marine Le Pen, appears to be slipping. Both Mr. Macron and Miss Le Pen are expected to make it into the second runoff in a repeat of the 2017 contest, but Mr. Macron's popularity has fallen in recent weeks after the initial bounce inspired by Russia's invasion of Ukraine. Of the 4 competitors to Mr. Macron who have been polled regularly, it's clear that Miss Le Pen stands the strongest chance of beating Mr. Macron in a runoff. The latest polls show just a 2 to 3 point gap between the candidates, with Miss Le Pen on 48.5% and Macron on 51.5%. This is a far cry from the 2017 polls. Through the run-up to the race, put Macron consistently well ahead of Marine Le Pen. Throughout the campaign, polls rarely estimated Macron's vote share at below 60% and Le Pen's at above 40%. In the end, Mr. Macron won in 2017 election with a 66% of the vote compared to Le Pen's 34%. What's really interesting is the potential opportunity for market moves off the back of these elections this weekend. As we look towards the 2017 data, we can see euro dollar on the first run-up had a 1.46, so 1.5% gap over the weekend, with the euro rallying off the Macron election, and also here the CAC 40 with a near 2% gap to the top side. Both of these markets continuing to rally in light of an Emmanuel Macron election. Potential with Marine Le Pen, far more competitive this year, dialing down a lot of her more extreme views and becoming far more popular amongst a broader demographic within France. There are still huge potential threats here, and it'll be interesting to see, should Macron start to gain back some traction, if we'll see this positivity flow into euro and into the CAC 40. But there is of course also the opportunity here for a gap to the downside should Marine Le Pen gain more traction and start to take a lead and win in this first runoff vote. Time will tell as we come into the weekend. We of course must be careful with any trades we take over the weekend. Manage your stop losses, your positions, as this is certainly an opportunity for gaps coming into trading on Monday. So, quick overview there of the markets. There's action happening in France, the US, and of course the ongoing geopolitical tensions between Russia and Ukraine. We'll look towards next week to see where these polls fall and where the election sits and any volatility may come from it. We'll look to see if the Australian dollar will continue to see this weakness and if the S&P 500 and some of the indexes will also move lower, running away from perhaps these 50% retracements and resistance that's being tested at the moment. That's all from us this week here at LAT. Please do join us same time next week.